Hello, everybody, and welcome to my class. Today, I want to talk with you about a very good and reliable technical indicator, which I often use, and I think is pretty reliable, even though it has its limitations. But please welcome the Bollinger Band, one of truly the most popular technical indicators, and I strongly recommend you using it. All right, so first of all, what is Bollinger Band? Bollinger Bands are enveloped plotted at a standard deviation level above and below a simple moving average of the price. Basically, we're talking about moving averages here and really simple measurements. Nothing special. Bollinger Bands help determine whether prices are high or low on a relative basis. They are used in pairs, both upper and lower bands, and in conjunction with a simple moving average. When stock price continually touch the upper Bollinger Band, the prices are thought to be overbought, and on the other hand, when they continually touch the lower band, prices are thought to be oversold, triggering a buy signal. When using Bollinger Band, designate the upper and lower bands as price targets. Bollinger Bands use two parameters, the period and standard deviation. The default usually, which I use, is the 20 and 2, 20 days period and 2 deviation standard deviations, although you can customize the combinations. And if you're looking for the short terms, then I'll take a look, just change the settings to 10-day moving average bands and 1.5 standard deviation. Should be like 1.5 times the standard deviation plus minus the short moving average. And if you want to look on the longer term, then take 50-day moving average bands and 2.5 standard deviations. All right, so this is a simple settings that you can do platform. And basically it shows us that there's two, as you can see, there are two upper and lower bands. This one is the upper, and that's the lower band. They are just simple moving averages that are calculated with two standard deviations. And the green line here in the middle is the short moving average, simple moving average. And basically what we see here is a graph of a stock during time. What we can see here is basically the most important and interesting thing about Bollinger Bands is that they're getting narrowed and then they're getting widened. They're narrow and they're getting widened. And this is a thing that we should keep in mind and look. And basically what it tells us that if we're having a falling bandwidth, that definitely reflects a decreasing volatility. And when it's rising, bandwidth reflects increasing volatility. Falling bandwidth reflects decreasing volatility, and rising bandwidth reflects increasing volatility. Then, okay, and the middle line, as you can see here, the green middle line here, is the line of the SMA, the simple moving average of the instrument's price. Also, it is best seen and combined with the RSI indicator. So what we see here again, it's the stock graph during time with its candles. Basically, what you can see that whenever the stock price rises up too much, it even crosses and goes well above the upper Bollinger Band, you can see that it always comes back and tries to get back into the middle of the SMA, the middle line here, the green line. Whenever it touches back also again. So you can see that whenever it crosses, it always comes back into the lines. Okay, now, as you can see here, when the stock started, as you can see, the bands are pretty wide here. And then for a very short time, we can see that they were really getting narrow right here. And then boom, something happened and spiked up, and spiked up well too much above the moving average. And then it had to pull back and then go back again. And then you can see here, it spiked out of the lower band, and it tried to reach back and it still fell down, but this time it fell into the Bollinger Band's lower band. And you can see that also here. It fell pretty sharply, and always, as you can see, it always playing with the upper and lower band, the upper and lower band. Once it reaches out of the Bollinger Band, it has to come back. This is how it works. Physics. I don't know. It always happens. It's always like that. When you see a stock that is already crossed, like here, you know for sure this is not an entry point. This is not a buying signal. You have to wait until the stock will correct itself and go back, pull back a little bit. And then that might be a good signal entering back into the stock. Okay, so this is basically Bollinger Bands. I truly recommend you using it, also using it with a combination of the RSI indicator. And it goes pretty well. The only thing about, I can say negative a little bit about the Bollinger Bands, that they tend also to stay close or in one of the bands for a very long period of time, and that shouldn't be exactly a good symbol entering or selling signals for you to get into the stock. So you can see an example right here, and also here you can see that as I spoke before, you can see that it's already touched the lower bound right here, so that might have signaled an entry point for you, but then it still fell and fell and fell, even though it touched the lower band. So it's up to you, but for sure, keep in mind that narrowing, Bollinger Band narrowing, something's going to happen. It might jump up, it might fall down. We don't know, we don't always know, but something's going to happen for sure. Narrowing is not a good thing. It's not, doesn't mean that everything is calm and relaxed with the market now. It signals something alert, something's going to happen. It might fall, it might rise up. So it's up to you guys to decide which direction it's going to go. That's it. Bollinger Bands, strongly recommend, but keep in mind that it doesn't always work. And wishing you all the best. See you in the next class.